Hey all, welcome to this episode of A Good Problem to Have. I'm your host, Tyler Olson. I wanted to talk to you today about some tips on navigating the physician mortgage landscape. Invariably, this product comes across your radar at one point or another, right? You're a physician, and this product is seemingly made for you. And in many ways, it is. It has some real benefits for younger physicians who are just getting out of training or are just even a few years out, and especially if you have student loans and cash flow is, it's new, and it's certainly more like much better than what it was when you were in fellowship or residency, but you have a lot of debt obligations and you probably don't have a ton of cash saved up. So the physician mortgage can be very useful for doctors to be able to buy a home, and it's based on the credibility of your ability to earn a high income. You have very, very high job security. I know there's always exceptions, but as far as the insurance world is concerned, and as far as underwriters are concerned when they're evaluating risk, you, a doctor, are a very low risk when it comes to taking out a mortgage. So that's why these products exist. And what I wanted to talk to you about, though, was some red flags to watch out for. Because these products are labeled as physician loans or physician mortgages, unfortunately, there is an uptick in lenders that say they offer this product and they don't really. Or they do offer it, but they don't really know what they're doing. They just want to be able to sell you on the brand that is, it's a physician mortgage, so you need this. They also will try in other ways to entice you. And so I wanted to walk through a few different things to watch out for. Before I do that, though, I want to lay out when a physician mortgage makes sense. Because sometimes it doesn't. If you have a lot of cash, or if you had a prior career and you're as some call it, a non-traditional path to medical school and so forth, you may have a different situation. But for a lot of doctors, the following applies. You have very limited savings after training, a lot of student debt, and you have an interest in purchasing a home even before your new job begins. Now, side point, any of you who know me know to be extremely cautious about purchasing a home early on in your attendinghood, let alone before you've secured the new job. So let me just say, this is an option. This product is designed, it can be designed to qualify doctors who haven't even started their new attending job yet, but that doesn't mean it's a good idea for you. I know doctors who moved to an area that they were like, this is where we're going to stay because we have family here. And a couple years later, something changes. And now they got to sell their house. The title of this podcast, it is a good problem to have. If you're moving because you're going to be making more money somewhere else, as the example I'm thinking of right now, it's a good problem to have, but it still is a problem. And you want to try to limit those, just because navigating finance and the purchase and sale of real estate is a headache. And you have a very intense job in life as it is. So just keep that in mind. Nevertheless, a physician mortgage can be useful if you're looking to purchase before your new job even begins. If you have a very complex compensation structure, like you're going to be RVU based, or you're going to be getting a guaranteed salary for a number of years, but then it's going to transition, working with the right person is, with this product, it can provide positive utility for you. Speaking of the right person to work with, let me just tell you, someone that I know who's done really good work in this world is Michael Zweisen. He's with Alliant Credit Union. They're based out of Chicago. They work with people all over the country, though, with the exception of the residents of Maryland. Maryland has some unique requirements. You have to have like an office, like a physical office there, in order to engage in this business. So if you're in Maryland or you're buying a home in Maryland, you can't talk to Michael, but I'm sure there's others for sure. But every other state, all 49 other states, you can talk to Michael Zweisen. He really knows how to navigate these things. Okay, so, and the last thing, limited self-employment history. If you are a 1099 physician, you know what I'm talking about. So working with a professional mortgage banker who really understands the physician loan, this might be very, very beneficial for you. So the problem, though, as I mentioned at the outset, is that there are more and more lenders that are putting themselves out as physician loan experts, and they don't really know what they're talking about. You could call it a rate and switch. You've heard of bait and switch. Well, this is a rate and switch. They give you a nice low rate and they say, yeah, we got a physician's loan. But then you get closer to closing and all of a sudden you realize that things are falling apart. They can't honor the rate. They can't close because you actually need to already be employed. These are obviously major red flags, and you want to be able to ask questions to make sure that that the lender is aware of your employment history and process and everything. You want to make sure that that they're speaking to you in a way that answers all your questions and that they truly are able to offer this rate to you and the terms are clear and that they understand your employment dynamics. So if you are a person where this makes sense because of those examples I shared with you about limited savings, loans, and complex compensation structure, then this might be helpful for you. One of the really good benefits of the physician mortgage is there's no private mortgage insurance if you put less than 20% down. Conventional mortgages require PMI, private mortgage insurance, to help offset the additional risk that the lender is taking by allowing you to not put down as much money. When you put down less money, your mortgage balance relative to the value of the property is a little bit more lopsided, and that's a risk. But with doctors, under this loan program, they're like, yeah, you're good for it. You've got a secure job. And then also the fact that you can put down up to 0%. Now, if you're borrowing $1 million, or if you're borrowing 1.2 million or 1.5, you're not putting 0% down. You are going to have to put down like 5% or possibly 10. But you'll still avoid PMI being under 20%. So that's why this has some usefulness in this case. So, but here are the 5 things to look out for. 1, not every physician needs a physician loan. Now, I know I mentioned like a number of the things that you do need to keep in mind that would show you that you are someone that should look into it. But what if you're not? What if you have established W-2 income? What if you have a lot of assets? What if you have really substantive employment history, even self-employment history? A different type of loan might be better for you. A conventional loan, a jumbo loan if you're borrowing a ton. You got to look at different rates and terms and compare it to the physician loan, because maybe you could put down some money and you'd get a better rate going with a different type of loan. So again, working with a mortgage banker who is knowledgeable about non-physician mortgages. If they're just physician mortgages, that's all they're going to want to talk to you about. You want to get a variety so that they can show you, hey, this is what we could do if it was this type of loan or this type of loan or this type of loan. There's terms, sometimes there's adjustable rate mortgages that they offer you where the rate's like lower. It's like, oh, it's only 5.25%. And that's much less than what I've heard people are getting of 7. And it's like, well, yeah, but in 5 years, the lender will adjust the rate according to the current market at that time. And maybe rates will be higher and then your rate would go up. So there's considerations there. These are conversations you need to have with the person. By the way, your relationship with your mortgage banker should not exist entirely via email. You need to have conversations with them, talk with them, be able to have back and forth questions and answers. And that way you can make sure that you really have all your questions answered. So, but the first point, you may not need one. Make sure you're looking at all the options. Second, contract review really matters. A mortgage banker is not a contract attorney. That's not what we're talking about, though. We're not talking about negotiating or about the legality of a contract. We're talking about being able to understand the financial implications of a contract, RVU incentives, collection-based compensation, call pay, relocation pay, future productivity models that are going to be coming in the future for you. Someone who knows what they're talking about is going to want to review the details of your employment contract, because that information is wanted by the underwriters. They are going to want to know all the details, and so you're going to want to supply those things. So you want to look out for a relationship and process where the contract is going to be a very important piece of information that needs to be reviewed. Third point, don't shop the rate only. A lot of people, they're like, well, what's the lowest rate? I'm going to go to this lender or this lender or this lender, and I'm going to go with whoever has the lowest rate. It sounds like it's smart because you're borrowing hundreds of thousands of dollars at a lower interest rate. Sure, it could save money, but what are the other terms of the contract, right? You want to not just compare pricing, because just because you get a low rate offered to you doesn't mean that you're going to close, right? So you got to be very careful about making sure that what you're being offered is based on a solid foundation, that the contract has been reviewed, that the lender is willing to accommodate your income structure, right? How are they viewing your student loans? How does that factor into their calculus? You need to have the answer. You have to have these questions answered. And shopping the rate, letting that be your guide, is unwise. Fourth point, and that is choosing the right lender. So there's a lot of lenders out there, a lot of people that put their name out there. They slap their physician-related marketing materials out there, and it looks all great. And it's like, this is for me. But that is not enough. You want to make sure that you evaluate the lender's ability to understand your type of income, your type of employment arrangement, because as they evaluate whether or not you qualify, you want to make sure that they have a full scope of what's going on. Things can change really, really fast. 2 weeks, 1 week, 3 days before close. All of a sudden, if the lender didn't get all the information they needed, and the underwriter is like culling through things because they look through it multiple times, they review and they review again, and then all of a sudden they'll be like, oh, we needed this one thing, or wait, what about this? And they didn't ever ask you this question, and your answer disqualifies you from the mortgage, and the seller of the property is like, what the heck? Well, we had a deal, right? And all of a sudden the house you're going to buy, it gets delayed. There's frustration. You want to have all this stuff out there in the open and evaluated and dissected thoroughly weeks and weeks, possibly months in advance, so that when it comes to actually offering something on a property to buy it, that this physician loan is both good for you and it is standing on solid footing. So those are the points that I wanted to share with you. I think it can be a very useful tool, and it has merit. So definitely consider it. But you want to make sure that you're not just comparing rates, that you make sure that the lender understands your contract, that they understand your income structure, and that they're actually able to offer you a physician loan. So get references if you don't know anything about the mortgage banker that you're working with. And I keep saying mortgage banker. It's important that you understand that that's a distinction from a mortgage broker. See, a mortgage banker is someone that works with a bank or credit union, and they are facilitating the lending of their own money. Whereas a mortgage broker, they're possibly working with a number of different lenders, and they're looking at, maybe with this bank or that credit union or whatever. And that's not to say that their structure is bad. It's not. I know good mortgage brokers, but they may come with less flexibility because they're not part of the company that is lending the money. They are brokering this transaction, which means that they are in between you and the lender. So you want to make sure that you understand the relationship of the person that you're communicating with, what their relationship is to the lender and to you, and how they get compensated. Ask them how they get paid. The ones that really nerd out on their jobs and love to help people, they will tell you because they want you to know and they think it's interesting. I found it interesting when I found out too. So be sure to ask them. Anyway, that's all for today. Thanks for listening. Talk next week.